Let me give the floor now to Luiz for his presentation. Luiz, you have 10 to 12 minutes.
Thank you, Soli. Thank you for the invitation, and very happy to be here in this very high-level panel. Let me share with you the presentation that I prepared. So this is about monetary policy, technology, infrastructure, and inequality, work done with colleagues of mine at the BIS, but we are expressing our own views here. And let me see what I'm going to talk about. First, why is it that monetary policy and inequality should be linked? Why do we bother? How particularly infrastructure can improve inclusion and therefore reduce inequality. Alert to the fact that you could have some technologies that can also increase discrimination and therefore inequality, and perhaps at the end how to balance precisely public policies to promote inefficiency and equity. To begin with, and to come back to Camille's initial points, the conventional view for monetary policy is that with the existing mandates of central bank, you already are doing the job by smoothing business cycles and reducing the length of recession. You don't necessarily need to do more if you believe that you are living in a world where the divine coincidence holds, because by stabilizing inflation and doing your job as a central bank, you are already contributing to address inequality. But if you think of a situation, and I think COVID-19 is particularly illustrative of that, where monetary policy may affect wealth and income inequality through a financial channel, for example, the prices of assets, well, then you have implications for the effectiveness of monetary policy. Particularly if you think not of homogeneous representative households, but you think of a world populated by heterogeneous households that would respond differently to monetary policy decisions. And then you might think that inequality that Camille was describing in the US does have an effect on the monetary policy transmission. And an illustration of that, I think Camille was talking about inequality rising in the US. You have on the left, by states across US states, the increase in the percent income share of the top decile of the distribution. You can clearly see that from the mid-80s, it has been rising constantly. Now, one effect of that, when you look at, let's say, what Camille was referring to in terms of the recession brought by COVID, but it is also true for the global financial crisis, the GFC in 2007, 2009, you can observe on the right panel that if you are in a more unequal US state measured by private consumption growth and the income share of the top 5%, the effect of the recession brings steeper declines in US consumption. So in a sense, you are already in breach of the homogeneous effectiveness of monetary policy. What is valid for the US, it's also valid for the world. Here we are trying to measure the recessions in several sets of countries by level of inequality. And you can see on the left that recessions in more unequal countries are steeper. This is a result that I was showing you for the US for private consumptions. If you belong to, let's say, the green, the sort of the higher inequality countries, the depth of the recession measured by private consumption falls. is much deeper, almost twice as much as if you are in a more equal country, the sort of the yellow column, where you do have a fall on private consumption, but at a lower degree than in more unequal country. We did some econometric work for 20 advanced economies, measuring the effect of expansionary monetary policy in terms of the effect on, again, consumption growth. And you can see on the right that if you are in a country with higher inequality, these are the sort of the darker little dots, you are measuring the central estimate of the private consumption response to a monetary shock. And you can see that if you are in more unequal countries, the cumulative effect on year 1, year 2, and year 3, the darker dots are much lower than if you belong to countries where you have a more equal distribution of income. And this, of course, has to do with the fact that in more equal or unequal country, you have a higher proportion of wealthy households with a lower propensity to consume, marginal propensity to consume, and therefore a smaller effect of your monetary stimulus. Now, can technology and particularly infrastructure solve a bit of this transmission problem in the effectiveness of monetary policy? Well, you can say yes. I mean, you have examples of this positive impact of the new technologies and new infrastructure. Think of India, for example, the Aadhaar digital ID that have allowed in about 10 years, this is the red arrow in this graph, for India to access at a much faster rate bank accounts for a much larger proportion of its population. This is the jump from 2008 to 2017 for India. If India had waited for the normal growth process, instead of about 10 years to reach 80% of bank accounts access, it would have taken about 47 years. What is valid for digital ID and this type of infrastructure is also valid for mobile money. You can see it's not only South Asia, the dark line that has increased progress in terms of accessing bank services. It's also valid for regions such as Latin America and also Sub-Saharan Africa and so on and so forth. And technology and infrastructure can also allow for much faster real-time payments. This is happening now with fast payment systems that are being put in place in many jurisdictions. It's following the RTGS real-time gross settlement systems that we put in place in the past for wholesale payments. But you have also a similar phenomenon that is now facilitating poor households and increasing the speed for smaller financial transactions, which is also an element that facilitates their life at a lower cost. Financial technology has also, as I think you probably have seen, reduced the cost of migrant workers' remittances. You can see here in the yellow line that the cost in percentage of the remittances, particularly for smaller, poorer households, has been much lower than traditional means and costs of transferring money cross-border by banks, for example. This is the red line. And you have also technologies such as the ratings of credit risk by new big data technologies have been increasing the access to credit for higher risk households and for SMEs. These are the representations of the probability of defaults using the traditional credit bureau types of measures of risk, and this is the blue lines, and the three major categories of broad, low risk, medium risk, and high risk. And if you use a more granular type of modeling of default risk by fintechs, the red dots, you can see that there is more differentiation of defaults. And one important aspect is that this differentiation allows fintechs to land in the sort of the right side of the graph, which is the high risk areas. 30% of these fintechs, and particularly one of them, Mercado Libre in Argentina, has been lending for this higher risk categories, where there was no bank lending whatsoever in this type of borrower in Argentina. So this, for example, answers one of the questions that Camille was referring to in terms of the effects of credit ratings on poor households. The technology also allows for a better prediction of probabilities of default. These are measures by the relative position to a receiving operating characteristic curve that measures basically how good is the predictive power of your model, which means that how you sort of rate the true positive rates of defaults to credit vis-a-vis false positives at various thresholds settings. And you need to be, of course, better than just a straight line, which is a kind of random model where you have a 50-50 probability of finding a false positive vis-a-vis a true positive. And you can see that the traditional bureau credit scores that are used by traditional lenders, the yellow and the red curves, perform worse than a machine learned model that uses big data. Again, this is a Mercado Libre in Argentina result, which then has a sort of a better prediction of true positives versus false negatives. And of course, if you have a better way of differentiating defaults, you can, of course, increase the outreach of lending in your jurisdiction. Now, of course, these are all the positive aspects where technology can improve inclusion, can improve access, can reduce or can be more granular in defining risk premium. But you have also some caveats. And this is, for example, the change in the default probability in US mortgage markets, measured with traditional models and comparing it with a more sophisticated machine learning based credit scoring. Now you can see on the left that the models using big data and machine learning all of them have predicting a lower default probability. But when you look in more detail about which categories of society, of groups in society, the improvement goes to, everybody wins. But you can see that, for example, some specific groups such as white, non-Hispanic, and Asians are winning or are getting more benefits than other specific groups, such as the white, Hispanic, and blacks. Compare the red lines to for example, the blue lines. So there is a possibility that these technologies are perhaps bringing some degree of discrimination in the distribution of benefits. We know also that the inequality in returns to wealth is a reality. This is data from Italian households. You can see that households in the top distribution top deciles of the distribution in pink at the top have a higher financial return. You can also see on the right that this is the effect of remote banking access on financial returns, and it can clearly be seen that the top deciles or the top percentiles of the distribution benefit more in terms of their financial returns from remote banking than the poorer households in the distribution. Another effect is the skill premium in the technology market. We have observed this in, remember, in the banking sector in the 80s and 90s. This on the panel on the right is also showing that US wages in the tech sector have been rising more rapidly than in other sectors of the economy. So this can sort of reinforce inequality through the well-known skill-based technological change. You can observe also in the left panel that this corresponds precisely with the very well-known rise in the value share of big techs in the overall stock index. And finally, on its own, fintech and those technologies and those types of new infrastructure have not necessarily been capable of closing the gender gap. You can see that the male participation on fintech products and service in all countries that are listed in this graph is much higher than the female participation in the usage of these fintech products and services. The red squares are much higher than the blue dark dots, which corresponds to the female utilizations of these services. So in conclusion, I think the monetary policy should be concerned with inequality because it affects its own effectiveness. This has been something that in the recent Fed review was very prominently featured, particularly when you begin using heterogeneous agent models, because you have a financial channel and you have differences in transmission. We have empirical evidence about that, and this is being reviewed by central banks. The new financial technology can certainly help inclusion. I think this is very important, particularly when you have crises such as COVID, but it can also bring some form of discrimination depending on the way it is used, depending on the way technology is being accessed by all or by only a few, and depending on whether technology is a substitute or a complement to labor. We know that this is a difficult assessment in terms of how this would impact long-term trends on wages, because you have many effects being combined here. You have the digital economy, you have demography and the supply of labor, and you have the way in which all this would impact savings. So in other words, for technology to promote inclusion, I think it should think of complementarity with labor and also of it as a public good with a broad and wide diffusion across all segments in society with more competition and less rents. And perhaps it is necessary to think of it to be thinking of it as a public good, to have some degree of reflection about regulation. Finally, these new technologies, particularly in the infrastructure of finance, may also help the efficiency of other policies. Think of, for example, the way in which we operate fiscal policies. And if we have now the capacity to identify digitally new IDs of specific groups that you want to target, for example, through CCTs, conditional cash transfer programs, if you want to have speed of transfers. And for example, of course, with COVID, you do need speed for addressing social issues, then if indeed these technologies in the field of finance can help a lot. And of course, if you add all this with better policy coordination, it can certainly increase the overall efficiency of public policies. So, Soli, I stop here. Thank you.